Hey there, community bankers. Welcome back to the Correspondent podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Kaplinger, Marketing Specialist for ICBB. Participation loans represent an opportunity for community banks to grow or manage their loan portfolio risk without exceeding their legal lending limit. But how does participation lending work at ICBB? To understand the participation process better, I spoke to a panel including our Chief Lending Officer, Brandon Feltner, Correspondent Loan Officer, Paul Loxley, Loan Operations Manager, Beth Soard, and Senior Credit Manager, Michael Searcy. Please welcome Brandon, Paul, Beth, and Michael to the podcast. Hey there, community bankers. I'm here with our participation loan panel. We've got Chief Lender Brandon Feltner, Correspondent Loan Officer Paul Loxley, Loan Operations Manager Beth Soard, and our Senior Credit Manager Michael Searcy. How's everybody doing today?
Doing great.
Good.
Good to hear. So most of you guys I had on the podcast last season to talk a little bit about participation loans. And for our audience, if you haven't listened to that episode, I highly recommend you go back and look it up as kind of a prelude to this one. But I wanted to have you guys on today to talk a little bit about the participation loan process for anybody who may be interested in that, what it looks like to get that started with us and see that through. So I'm going to start with a question for Brandon. And how does a community bank identify opportunities for participation lending?
Yeah, so that's a great question. Question we get asked a lot, and it really starts with the bank's, loan strategy and their plan to, grow or decrease, its loan portfolio either by purchasing or selling loans. We have a lot of banks that sell us loans that don't participate or don't purchase. And then we have banks that purchase loans that don't sell us loans. And it really just depends upon the bank's strategy and their loan deposit ratio, credit concentrations, kind of that mixed formula. And we also, have banks that, reach out to us that are just getting started, kind of, don't know what they want to do yet. And we have to go through that discovery conversation with them about what's their strategy, what are they hoping to get out of it, and then we can direct them, provide insight on what we do and what we've done historically to hopefully align with their goals to either purchase or sell us loans, or also perhaps have us originate a loan for us, for them rather, whether it be an officer director loan if they've got the opportunity for one of their executive officers to purchase stock. We can originate in that capacity where a charter's set up, or originating a holding company loan to help them if they're building a new branch, if they're just needing it for a line for contingency funding. There's different scenarios that we put together holding company loans for. And
yeah, that's really great to know. It's good to know, I think, that banks can come to you even if they're not really sure what direction they want to go, and that you can help them sort through that. I think that's really helpful for our audience to know. So along those lines, Paul, can you walk us through the initial steps a bank takes to engage in some kind of participation lending arrangement with us, both as a lead bank or as a participant?
Sure. So it all starts with communication. And if a bank would just reach out to us by sending an email to loandepartment@icbb.bank, and just begin with a question or want to know more, we can, main thing is start with some communication and find out what their needs are, what they're seeking, what they're asking for, and see where we go from there. Whether they're a lead bank or if they're wanting to be a participant, to get an idea of what types of loans they're interested in and what their capacity is.
we make it easy to do business with us, I like to think.
Yeah, I appreciate that you guys can also kind of serve not just as, lenders, but also as, a guide and help our banks think through, what are the best steps for them, what's the best way for them to engage in participation lending, be that as a lead bank or as a participant buying, selling, whatever it is that makes sense for them. So, Brandon, for a lead bank, what role do they play in setting the terms and structure of the loan once they've engaged with us?
Another good question. It really just depends on the scenario. Sometimes banks will engage us initially when they're first getting an opportunity to look at the deal. So they'll reach out to myself or Paul to see, what type of placement opportunities we would have based upon interest in that particular credit area, and then the size, the location. There's a lot of different factors that play into that. So banks will reach out to us to kind of gauge our interest as us being their primary participant. And then, we'll keep a good portion of that, but then we also have to be mindful of what we don't keep and what we sell downstream to our sub-participants. So it helps us formulate a plan with them and get together, a game plan to help them, get the deal, and also us to get it to the finish line. And as far as other opportunities, banks have credit concentrations or just different exposures that it's already on their books. They're just needing to divest the loan to kind of make some room for another loan with that particular borrower that's getting ready to do another loan. So they will either have us get involved in the new one, or they'll have us just entertain purchasing the loan that they currently have and get that off of their books to be able to make room for the new one. Either way works, whatever works best to their expectations, we're happy to do. And it just really just starts, like Paul said earlier on one of the questions, just communication and reaching out to myself or Paul to have that conversation, whether it's a new loan opportunity or an existing loan opportunity. And we can work with you to see how you've got it structured, to see if we think it's something that we could get involved in as a participant, and then get sub-participants involved to be able to fund the deal overall.
Yeah, that's great. It sounds like you guys are, very good about communication. But for banks who have communicated that, they're interested in loan participation opportunities, how do they get notified of, when an opportunity arises that might be a fit for them, Paul?
A good question, Madison. From the standpoint of banks being notified, they first need to be part of our network. And in order to be part of our network, just need to notify us that they'd like to be, and then we'll work on that separately. From the standpoint of how we notify our banks, once we have an opportunity for needing banks to participate in a loan, we put together a one-page summary of all the details which are the banks typically look for regarding the amount of the loan, the amount that we have to participate, the type of project it is, the pricing, the collateral, hitting all the main points that we can put onto one piece of paper so that a bank can make a decision. And we send that out to our network, and typically banks will decide within a matter of a day or two if they're interested, and then from there, then we get a short list of banks who are interested in that particular loan.
Okay, so the process starts with the bank reaching out to you to become part of the participation loan network, and then you reach back out with opportunities and information that they need to evaluate the loan opportunity. And you mentioned sharing the one-page document with each of these banks. But Beth, as the loan operations manager, how do you make sure that the participating banks have access to the information they need to evaluate the loan opportunity?
So once the bank has identified that they are wanting to further review our files, We use ShareFile to securely send all of the information out to them. So we would create a folder for each loan opportunity, and within that folder, there's going to be subfolders that's going to contain a financial folder that can have the borrowers and guarantors information, a collateral folder that has appraisals, title works, flood, as we are receiving those items from the lead bank. We will continue to add the documentation as we receive it. That's also where, once we complete our final credit memo, that we would share that information. So it's really just as simple as that bank letting us know that they're interested, and they tell us what employees within their organization need access to that information. We create them a ShareFile account to where that they can access that information. And they also do get notifications each time we add new items to the folder, so they can be aware of new items as they're continuing to underwrite.
Yeah, great points, Beth and Paul. One thing I did want to kind of reiterate what you all were explaining as it relates to participation loans. Historically, we've been engaged by the lead bank about being a participating partner, and then we would review that. We were interested, we'd move forward with underwriting. We would seek approval from our officer and director's loan committee, and then we would put that out for sub-participation to our financial network. Well, given just the unique environment that we've been in over the past 12 months, we've kind of taken more of a different approach, I like to say proactive approach, to where we have that first conversation with the bank. We would then formulate a plan to put together an opportunity memo, just basically highlighting all the key points of the deal and kind of what it's going to look at without doing a full underwriting analysis. There's no need to put in a lot of work if they need us to buy more than we can fund on our side. So what we have done is created the opportunity memo. We'll take that to our officer loan committee, get blessing there. Then we'll move forward from there with putting it out to our network to identify sub-participants to make sure that we can achieve the goal, achieve the loan amount that the lead bank has requested us to do. If it be $10 million, we want to make sure that we can get $10 million and not fall short and get $5 million. So I know a lot of the listeners, current customers, you've probably seen that happen, but new customers, just going to kind of explain how that looks. If you see an opportunity memo, and then from there you respond with your interest, and then that's kind of how we get it started from there. Just wanted to explain, that small change that we have put in place that's really worked well for us and our participants and sub-participants.
Yeah, I appreciate you kind of bringing that to light, Brandon, for anybody who might be listening. And thank you, Beth, for kind of going into how, we make sure our banks have the information that they need, and I know there's some due diligence required from, lead bank, participating bank, sub-participants, and a lot of, information that has to change hands. So, Michael, on the credit side, what kind of due diligence is required from the lead bank and the participating banks and the sub-participants before they enter into a participation agreement?
Yeah, so I can address the due diligence that would be required from a credit perspective. So we're talking about on a specific loan or credit request that comes across our desk. As both Brandon and Paul referenced earlier, typically the main reason a lead bank is reaching out to us for us to share and participate on a loan is because they're either bumping up against their legal lending limit with any particular customer or borrowing relationship, or perhaps they're bumping up against their CRE concentration limits that are regulatory limits, including the 100% of capital on all of your construction loans and 300% of capital on all CRE, excluding owner-occupied, of course. They might be bumping up against their internal concentration limits that they have approved internally by the board. And maybe that's certain limits on retail space. It might be office space, multifamily, industrial, special use, C&I, just any kind of a specific loan type or collateral type that perhaps internally they have set a limit on as a percentage of capital or total loans. And so, they have a good customer that comes to them and has a large loan request, and the lead bank's not able to accommodate unless they reach out to ICBB and have us share and participate in on that loan request. So once that comes our way, then we, as Brandon referenced earlier, we'll do a water cooler. And so Brandon and Paul and Derek and myself and Beth, and we'll just do an initial water cooler and just trying to determine the risk appetite, our risk appetite for the deal. What's our appetite for CRE or CNI or multifamily construction? What's our risk appetite when it comes to, the interest rate that's being proposed? Or, we're going to look at it from a cash flow and debt service coverage perspective, going to look at global cash flow and include all the guarantors and just kind of put it all together and see if it fits our risk appetite. And if the answer is yes, and we decide that we want to move forward, then the next part of the due diligence process is underwriting it. And I think sometimes the question might be, well, the lead bank's already done that. They've already crunched the numbers. They've already underwritten the deal. They've already spread the financial statements. They've done the cash flow analysis. Why would you need to do that? And it's not that we don't trust the numbers or the calculations that are being provided to us by the lead bank. It's just an expectation of the regulators, and it's prudent. Every bank has a different set of policies. Every bank has a different set of prescribed standards that they want to try to adhere to based on their credit culture. They want to do deals that have minimal exceptions to loan policy, and certainly don't want to have layered risk, or what the regulators called layered risk, which is having multiple exceptions on any type of loan. And so that's why we have to do our own due diligence. It's not that we don't trust the numbers that are coming to us. It's just we have our own set of policies. We have our own credit culture, our own prescribed standards. And so we take a look at it just as if it was a credit request that came directly to us. We have to treat it that way. And so we collect all the financial statements from the lead bank. We spread those financial statements ourselves. Again, even though the lead bank already did that, we're going to spread those ourselves. We may have a different way of looking at cash flow. We may have a different way of looking at guarantor financial information and tax returns and K-1s. And so we're going to come up sometimes with a little bit different ratios and bottom lines and debt service coverage ratios and what have you. And then we'll do our own underwriting. We're going to have our own narrative and credit analysis, come to our own conclusion. We're going to do our own appraisal review, and we're going to go through our own approval process, whether that be our own officer loan committee, director's loan committee, or full board. And then once we get our approval, one of the challenging things about correspondent banking with respect to participation loans, particularly when we're also sharing the loan with sub-participants downstream, is they have to go through that entire process themselves for the exact same reasons that I just discussed. It's a expectation that they do their own due diligence. And so unfortunately, the participation loans, it's not something that happens overnight, and it takes some time. And so, as long as banks go into that, understanding that, and have the patience to know that it's going to take some time, then it works out. The participation loan process works out very well.
Right. I think that's important for everyone to understand. And I think it's important that they understand the background of, all of the due diligence and the spreads and everything that each bank has to do. But, beyond the kind of technical credit side of participation lending, there's also the relationships between several different banks at a time. So this will be a question for Paul. How do you manage relationships between the lead bank and participating banks to make sure that they have a successful partnership?
Great question, Madison. And so I'll first address the lead bank. And so when we are working on opportunities, we are having regular communication with them once we have identified and know that we can fully sub-participate and take the full balance that they need us to take, having regular communication with them to make them aware that we've got the entire loan sub-participated, and what the timeline is for the approvals from ourselves as well as our sub-participants. And myself and Brandon are typically in communication with those lead banks. But then in addition to that, we also have our credit team, Michael and his underwriters, in communication with their staff, just to make sure that we're all on the same page because of underwriting and so forth. To help clear up any questions and just make sure that we're underwriting it and clearing up questions that may surface. Sometimes they do, sometimes they don't. But it really just comes down to having regular communication with the lead bank on that side of things and keeping them informed of where we are in the process so that we can get to the finish line with them on their expected timeline. Now, when it comes to our sub-participants, it's also active communication, keeping them aware of things that are happening. And of course, as Beth alluded to, anytime there's documentation that's added to the folder and share file, they get notified every time any document is uploaded. So they're getting that, but additionally, we're sending emails directly to them, keeping them posted on what the tentative closing date might be, and making sure that they know where everybody stands. And of course, we require communication back from them regarding when they have approval so that we know and can document, because until we have all of the approvals from our sub-participants, it's not until then that we can then be ready to close.
Yeah, it's something I'd like to add to that too, Paul. You mentioned you and I as the lenders and the credit analysts staff, but also to our loan operations. Beth and her team has a lot of communications with, all of our sub-participants and even, our clients where we've originated loans for them. So there really is a strong cohesive effort between the lending team, the credit analysis team, and loan operations. We're all one big team together, but there's lots of contact points that you will, get communication from. And, we all meet daily, Monday, Wednesday, Friday. We have an officer loan committee on Tuesday, director loan committee on Thursday, and then a board approval is needed. So we're all working together like a well-oiled machine to stay abreast of each and every credit that we have, and then ongoing monitoring of our loan portfolio, credit risk, and just overall quality.
Yeah, it sounds like it takes a lot of, communication and back and forth to get a participation loan to closing from all sides. And it sounds like you guys are, great about that and keeping up that relationship. But I'm going to jump to, after a loan is, closed, it's been funded. Michael, how is the loan then monitored and managed after the point where it's been funded, and what reporting processes are usually in place?
Yeah, so after a loan has been funded, the monitoring that is required really is going to depend on the type of loan that it is, right? So if it's a construction loan, obviously there's going to be a lot of monitoring, documentation collection, what have you, that would be required in the first 12 to 24 months during that interest-only period while the project is being constructed. You might have a C&I loan, asset-based lending loan secured by receivables and inventory. That's going to require likely some quarterly or even monthly monitoring and so that would involve the collection of accounts receivable agings and borrowing based certificates and what have you, and then you've got a normal term loan. So really, the monitoring after a loan has been funded depends on the type of loan, but at a very minimum, we're looking at the collection of current financial statements, which is really important. So it all depends on what the loan agreement requires for that particular loan. But it might require monthly interim financial statements or quarterly or what have you. But at a minimum, we'll be collecting annual financial information on the borrowers and guarantors, tax returns, guarantor personal financial statements, K-1s to go along with the tax returns. So all of those at a minimum. And when in terms of what type of mechanisms are in place, just to kind of ensure that this monitoring is taking place, annual reviews of a borrowing relationship is a great tool or a resource to trigger the collection of current financial information. So at a minimum, if we don't have a tickler system, which we internally do not have the best tickler system currently, but we're looking at a new platform that might work for us, and we're looking at some additional features that our core operating system might have. But at a minimum, we're doing annual reviews of all of our existing borrowing relationships, and each time an annual review comes up, if we don't have current financial information in file, then we're reaching out to the lead bank to request that information. And then again, as I mentioned earlier, construction loans require a lot more monitoring on an ongoing basis, and Beth really has her hands in that quite a bit, as well as our president, Derek Hetherington, and reviewing the draw requests that come in. But, we're looking at AIA docs, we're looking at date down endorsements, title updates, the inspections, and what have you.
Michael, thanks for elaborating on that. I kind of want to throw in here that I had mentioned earlier that when we're in the early phases of underwriting, we're using that share file folder to share the information securely with our sub-participants. Even after the loan is funded, ShareFile is a vital tool that we use to continue to supply additional documentation. That's where we're going to upload all of the loan closing documents. If it's a construction loan, that's where we're going to upload those inspections and AIA documents and our funding cover sheets. So we continue to use ShareFile as a way of communicating things. And as Michael's team is requesting those financials, that's also where we're going to continue to provide those additional items to keep everybody up to date on all of the things, whether it's collateral related for insurance or anything that, has come about.
Yeah, I think that's helpful for our listeners to understand about the process. Brandon alluded to the past 12 to 24 months kind of being challenging for a lot of our banks, and our economic predictions don't always pan out, and sometimes changes are necessary to agreements. So Brandon, I'll ask you this question, and Michael, you can chime in from a credit perspective as well. But in a participation lending scenario, how do you handle things like loan modifications, restructures, or even defaults?
Yeah, so how we handle, loan modifications and restructures is essentially how we got started with the loan. We're going to look at the opportunity at hand, the request from the lead bank, or if it's something that the customer's requested from us, if we've originated, it's a bank holding company loan. We're going to make sure that we gather all the financials and everything that we need to make a decision. And it'll have to go back through our approval process of going through officer loan committee, needs further approval through our director's loan committee, and or even further to our board. And if we have sub-participants, we'll share all of the information that we gather as we gather it, and then allow them to be able to do their due diligence and underwriting to make sure that they approve the request and, it meets their expectations. And sometimes we do have banks that don't agree, and sometimes we have banks that, do agree. And it's just, you just work through that process to make sure everybody gets on the same page.
Right, absolutely. Thank you guys for kind of walking us through the participation loan process. Before we go, does anyone have anything that they would like to add about participation lending or the process or any of that before we close?
Yeah, Madison, I also wanted to just take a moment to address what happens in the event of default. And let me just say that that's a very rare occurrence here at ICBB. When the participation loan process, you've got the lead bank doing all of their underwriting on the front end. You've got ICBB doing all of our due diligence, as I discussed earlier. And then in the event that we have sub-participants, they're doing due diligence, underwriting. So by the time that a loan actually gets approved, I mean, there's been so many hands, so many eyes on that particular deal that it's buttoned up pretty tight. So events of default are very rare. And if you look at loss history for ICBB, it's been very, very low over the past several years. But in the event of default, and I've only been here for less than a year, and so I've not seen any loans go south. But I think typically the lead bank would take the lead on that whole process, and it might depend on how much they hold or who holds the majority share of the note might determine who carries the most decision making power on that. I'm not sure, but sometimes, as Brandon alluded to earlier, we poll our sub-participants on certain things and certain decisions that need to be made. So in this case, and in the event of default, if we're looking at potential foreclosure or a forbearance agreement, everybody's going to have a chance to have a say in that. And whenever a loan becomes a managed or criticized asset, all sub-participants are going to be well informed of what's going on a weekly basis, if not daily sometimes. We're going to be sharing any and all documentation that's coming to us from the lead bank, any correspondence that we have via phone or email. We're documenting that and sharing that with our subs. Conference calls, any conference calls that we have, we'll take detailed notes and share that with subs, and then we'll also sometimes have conference calls with all the subs and lead bank and get everybody together and make sure we're all on the same page. And then at the end of the day, worst case scenario, if I would imagine that any loss would probably be, I'm guessing it's shared on a pro rata basis. And that's how that would be handled. But I've not seen that since I've been here at ICBB, and I don't think they've seen that in a very long time.
Thank you for listening to the Correspondent podcast from Independent Correspondent Bankers Bank. We hope you've heard something that you can take back to your community bank. Be sure to follow us wherever you get your podcasts. If you're listening on Apple Podcasts, leave us a rating and review, or on Spotify, turn on the notification bell so you never miss an upload. See you next time, community bankers.